to fall after seeing their worst week since September amid mounting growth risks. Joining us now with more, we got Tom Hayes, Great Hill Capital Chairman and Managing Member. And Tom, we've been speaking about whether or not this is a recession risk trade that we're seeing playing out in the markets. Where are you seeing buying opportunities? Are you repositioning at all amid the increased risks?
Yeah, I think this is a great opportunity. I mean, sentiment is basically flushed out. You've seen hedge funds selling in the hole like never before in the last 2 weeks. They're always a contraindicator. You've seen retail investors buying more insurance after the house is already half burned down. You want to buy the insurance before the house is burned down. Put buying is near a record high for retail investors. So we're in the normal seasonal pattern of an election, post-election year, which means February is weak, early March is weak. And why is that? It's because of policy uncertainty. It happens every single 4 years, and we don't need good policy. We just need known policy. And once we have known policy, look at earnings, up 18.2% for the last quarter. I think things are actually in a good position. But the one thing that no one's talking about that I think is more important than anything else is not tariffs. It's actually the unwind of the carry trade, which fueled the most crowded trade in the last few years, which was Mag 7. And all you need to do is look at 10-year yields of Japanese government bonds. And they've gone from 0 to 157. That's the highest rate in 20 years. And that was what we call a funding currency that had zero cost of carry, now has a cost of carry. So as that trade unwinds, the hot money is coming out of the Mag 7 and momentum stocks like Palantir, like NVIDIA, et cetera.
Yeah, I was going to ask you what the correlation is to the Mag 7 there. Why that matters when we see an unwind of the yen carry trade, and how that ultimately impacts some of the inflows or outflows, I guess, in this case, for the Mag 7.
Yeah, you can actually overlay the PE ratio of Microsoft to Japanese government bond yields. And you can see as Japanese government bond yields increase, okay, the cost of that capital goes up from 0 to a carry cost, the multiple of Microsoft compresses. And that's over long periods of time. So while everyone's talking about tariffs, look, you know, you could look at JGB chart, you could look at tariffs chart. Tariffs chart, we're near 100-year lows in terms of tariffs. And what most people forget, as you hear Hawley Smoot every single day on TV, is that they raised tariffs from 1918 to 1929 for 11 consecutive years to levels much higher than anything we're close to right now. And the economy boomed before Hawley Smoot, when that was kind of the straw that broke the camel's back and coincident with a big sell-off that we all know about. But I think there's a lot of runway in terms of tariffs. I'm not pro-tariffs, but I'd be less concerned with that. I'd be watching that funding currency as it relates to the crowded trades of the Mag 7 and be looking outside of the Mag 7 for opportunities in the U.S. And be looking aggressively in international opportunities.
You know, I guess we're all talking about tariffs, though, because it's what all of the companies are talking about right now, too. Yeah. The FactSet stat most recently saying the highest number of S&P 500 companies citing tariffs on earnings calls over the past 10 years here. So this even moves through the last time in Trump 1.0 that we were thinking and talking about and seeing the implementation of tariffs. And so how are you hearing and assessing companies who are trying to bake this into their own forecasts for the rest of the year?
Yeah, I mean, welcome to Trump 2.0, same as Trump 1.0. As a matter of fact, I saw some analogs and overlays. You could see the stock market in Trump 1.0 when the tariff talks were escalating in accordance with the graph you're talking about. And we're effectively in the trough right now. We're going to get certainty. We're going to know a lot can happen between now and April 2nd. He didn't want to do it on April Fool's Day. Maybe he should have, because I don't think they're going to look exactly like they look right now on April 2nd. I do think the other thing that people are not really accounting for aggressively is if it is a worst case scenario, what it brings back on the table, which had been off the table the last 8 weeks, is the Fed put comes back into play. We've seen the odds of a Fed cut go up to over 85% in June. Just a month ago, everyone said no cuts in 2025. So here we are. We got the Trump put effectively coming back in potentially, but the Fed put coming back in. And oh, by the way, what's happened in the background no one's paying attention to? Besant and Trump have delivered on what they said they would do, which everyone was laughing at when the 10-year yield was at 4.80. It's now down 60 some odd basis points. That's going to help refinance debt. That's going to help stoke the housing market again as 10-year yields go lower. And no one's really positioned for that. Home builders, you can't give away right now. Home building supply companies, you can't give away right now. And I think there's going to be great opportunity there with lower and lower rates. You're seeing it on the 30-year mortgage tied to the 10-year.
All right, Thomas, thanks so much for taking the time here with us today. We got about 20 minutes until the opening bell here. We'll leave the conversation right there. Appreciate it.
Thanks for having me.